you're looking at $2 million. So $2 million plus $3 million, she's getting $5 million from $1.5 million from 2 IRA accounts. How's that for a guaranteed retirement that will never go away and satisfy the RMD requirements and provide peace of mind? Hey, welcome to the Guaranteed Retirement Guy show. So I'm your host, John Stevenson. Thanks for tuning in. I am really excited to talk to you about a client that I'm working with. So he's got $2 million. We're going to turn it into $6 million. All right, so let's get into it. Let's see exactly how this works. So a fixed index annuity can be used to guarantee income, but it can also be used to provide a lot more income than if you were just withdrawing from your account and letting your account go dry, right? And a lot of clients I talk to, they think that is their option. They'll go in and say, hey, I've got $500,000. I'm 65 years old. I'm hoping it'll last me, right? And if it doesn't, then hopefully I die. Hopefully I die early, right? But really, is that the way you want to look at your retirement? Is your retirement a plan for living, or is it a plan for dying, right? Really, our money has two different purposes, okay? We either have the purpose of living, okay, or the purpose of dying. If it's for dying, then we're leaving it behind for our kids and we don't need the money. But if it's for living, then typically we want as much income as we can. And if we can, we'll try to get way more income than what our account balance is. So our account balance, if it's $500,000 or $200,000, we want to maximize that, right? We want a lot more. And a fixed index annuity can do just that, okay? So I'm going to share my screen. I'm going to show you what we did, okay? And so let's just kind of pull this in here. Okay, so if you can see this, you'll notice that I am looking at $850,000 premium right over here on the left, okay? So if you see that, you'll see $850,000. So this client has roughly $1.5 million to play with, okay? And again, we're looking at maximum income. Okay, maximum income, maximum ROI. If she withdraws from this account over a period of 10, 15 years, the amount of money that she actually wants to take out is going to deplete her account well before she passes away. So here's the plan that we put together. All right, so if you see $850,000 going in here, Nevada, age 68. Now she wants to wait until she's 80 to take this. And the reason why is because she has a pension right now. It's kind of like a deferred comp, which only lasts for 10 or 15 years. She's got 3 accounts. One account is, giving her $70,000 a year for 10 years. So pretty good. The other account's giving her $36,000 for 15 years. And then the other account is giving her another $70,000 for 15 years. The bottom line is, even though the income is great, that it's designed to deplete all 3 of those accounts, and she has no choice. She can't take the money out. She's tried. And I guess the company that she is with, they're not letting her touch it. So not a great situation, but really it is what it is. So she has that. She's going to have that income, from 68 for, 15 years max, which would be 82, 83, and then it's all gone. Okay. So she has that, but good for her. She also has these separate IRA accounts. Okay, so we have 2 separate IRAs. We're looking at one $850,000 and another one for $700,000. Okay, so I'm going to show you the $850,000 first. And what you're seeing here is you're looking at $850,000 going in, and then it's dropped in for 13 years, and she starts taking the income at age 80. Okay, at age 80, she's taking out $166,000 a year for the rest of her life. Now, let's look at another graph. Let's see exactly how this looks. $166,000 a year coming out at age 80. You can see with a fixed index annuity, it typically will deplete it depending on the growth, but we're just showing okay growth. But what happens is the income continues, and you notice that the total income at age 97 is 2.99, pretty much $3 million from $850,000. Not bad. Okay, so she's got $166,000 But again, she has another concern. This is one IRA account. Okay, so keep in mind, one IRA account, she is she's funding it with $850,000. Then she's got her second IRA account where it is going to give her a little bit less income because she's taking it early and it's less money. Okay, so let's look at that. So we're going to go in here, use $700,000. So we'll change that. And now she has to take out early. She is forced to take out early. And let me tell you why. She came to me and she said, hey, I've got this one IRA. I want to throw in $850,000. I need to turn on income at age 80 because I know the rest of my accounts are going to run out at 82, 83, right? So I want to have this income that's going to last me the rest of my life. Okay, so that's what she's doing with her $850,000. But here's the dilemma. She also has RMDs. Okay, these are tax-deferred IRA accounts. She's subject to RMDs at age 73, which is a problem if she wants to let these accounts sit. Like for instance, this first annuity needs to sit for 12 years in order for the roll-up rate to accrue the account balance to a point where she gets that guaranteed income of $166,000 a year. So how does she fix this? She needs to do RMDs. The government's going to force her to take this out. So how does this work? Well, looking at 4% RMDs, she's going to need to take out roughly $60,000 out a year to satisfy the RMD requirement for her 1.5 million portfolio between her two IRA accounts. Okay, so that's what she has to do. Her initial thought was, well, I'm just going to deplete my $700,000 account. I'm going to take out $60,000 a year. I'm going to deplete it down, and that'll take care of my RMDs until the time that I decide to turn on income from this first annuity that I'm funding for $850,000. So I'll have that $166,000 the rest of my life. I'll be okay. And not as much as I'm making now, but it'll be fine. And my other account will run dry, but it'll satisfy the RMDs until I turn on the income from my IRA. Here's the beautiful thing. She can fund two IRAs. She can fund two annuities with these two IRAs. Okay, so she is going to take $850,000 from one IRA, stick it into the second IRA with the insurance carrier, $850,000, gets her $166,000 of income at age 80. Okay, that's one IRA. The second one, though, the solution I gave her was take the $700,000 and also stick it in another IRA, fund an annuity in that IRA as well. Because as you can see here on my screen, you notice in 5 years, age 73, which is her RMD age, she has to take out $60,000 a year, right? Well, you can see this guaranteed income right here is $82,768. And I'm looking at, quite a few carriers here. She could pick some other carriers, but if she wants the highest growth possible, I like to show her the highest paying one. So it's up to her what she wants to do, but essentially what I'm showing her is an account that's never going to go down in value. It's never going to be depleted. And now she's going to have $82,000 plus $166,000 for life, $248,000 a year for the rest of her life. And if you look at this one, the $82,000 a year, that's going to pay out. If that starts out at age 73, her RMD age, and it runs the same amount of time as the other annuity, you're looking at $2 million. So $2 million plus $3 million, she's getting $5 million from $1.5 million from two IRA accounts. How's that for a guaranteed retirement that will never go away and satisfy the RMD requirements and provide peace of mind? That's what she wants. She wants peace of mind. She wants the income. She knows she has it with this. And so that's just, that's the beautiful thing. I'm so excited for her. we're going to be chatting here in the next couple of days, and we'll set these accounts up for her, because really this is the way it works. When you are looking to maximize income and you're looking to, you're looking at your assets and you're like, all right, well, how do I protect this? Maybe the market's going down. How do I protect this from going down? But on top of that, how do I get income, right? I mean, the whole reason why we build up these piles of money is for income, right? So she's looking at this and she's thinking, all right, well, I need to protect my money. I don't want it to go down anymore, but I also need income because I know my other pensions, my other deferred benefit accounts are going to run out because they're only set for a certain amount of time. And so knowing this, she is planning for her future. And since she has some time, this is really what's helping her, because these annuities have roll-up rates. And these roll-up rates earn, 7, 8%, sometimes more, depending on the company. And what that is it's an income account value that's growing at that 7%, let's say, for example, every single year. And so when she actually decides to turn on the income, the withdrawal rate's somewhere in the 8% range, and they're just multiplying that by the income account value, which is very, very high because it's had that roll-up rate. And so when those are both multiplied together, it gives you that guaranteed income at that age, which is $166,000 for one account plus $82,000 for the other account. And the only difference now is she's never going to deplete her second IRA, and she's going to have income last forever. She's going to satisfy the RMD requirement. So she's killing a few birds with one stone. So she's pretty excited. It was a fun meeting. It was really, when I get to talk about this and I get to explain and show people how their money can multiply their income at retirement. And when I see the light turn on, it's just awesome. It's fulfilling. It's exciting for me, because I'm seeing them realize, hey, this money I've worked so long for and I've worked so hard to protect is going to actually give me a lot more than I thought. So anyways, this is what we're going to set up for her. I'm really excited to do that. And if you want me to look at this for you, send me some numbers over. You saw what I did on the computer. I'd be happy to just put in some numbers, and there's just different carriers work differently for different people, different ages. Maybe you and your spouse have a difference in ages and you want joint income versus single income. There's so many different things to think about, and there's different companies that work better. There's different products that work better, and I like to show you everything. So you can pick. I'll recommend, but I like to just at least let you see what the top ones are, what the top solutions are, and then you can make your choice. So anyways, I like to work that way. Hopefully that's something that would help you out as well. Anyways, happy to look at it. Book a call if you want, or send me a message, and I'm happy to look at it for you. Thanks. We'll see you next time.